Good day, everyone. Thank you for joining me. My name is Undertaker. Today, I'll take you through Heineken's first half results for FY21. Starting off with our executive summary. So the company released its first half results on the 2nd of August this year. The revenue was a miss, while the EPS was ahead of market expectations. Key takeaways were as follows. Strong top-line growth, which was supported by strong pricing as well as volume growth. So speaking to the actual values for volume as well as price mix, so volume was up 8.2%, but Europe on trade volumes were still down to low single digits. Price mix was up 5%, driven by assertive pricing in Nigeria, Russia, as well as Ethiopia. While we're seeing signs of recovery in the on-trade sales, it's still well below the 2019 level. It's estimated to be at least 50% below the 2019 levels, while off-trade is growing ahead of the 2019 levels, driven by premium. The company has also reinstated dividends at 28 pence, overall maintaining a neutral recommendation on the counter. Moving on to the actual performance of the stock in the first half of 2021. So organic revenue was up 14%. When we account for Forex, net revenue was up 8.3%. Beer volumes was up 9.8%, with the Heineken brand up 19.6% in volumes. And this was on the back of strong demand in Africa, Middle East, Eastern Europe, as well as Americas. Evergreen strategy deployment has started. This is a cost-saving program under the new CEO management team. So we are encouraged by it. Overall, management has guided that financial results for FY21 will remain below 2019 levels, and this is on the back of Europe not doing well. We'll remember that Europe contributes at least 44% to EBIT. So it's a big chunk of the group revenue that's not doing well this year. Looking at how the market reacted following the results release, the share price was down 0.6%, while the Dow was up 0.1% on the day. So overall, it was a muted reaction. But when you look at how the share price has performed since our last recommendation on the 8th of March, the share price has actually underperformed since that last recommendation, with share price up 5.3%, while the benchmark has been up 18.2%. On an earnings basis, EPS estimates for FY21 have been on an upward trend since our last recommendation, reflective of the top line momentum. Lastly, when looking at our business, so on a forward P basis, the group has become cheaper since our last neutral recommendation. It now trades at a discount of 9.9% when you compare it to the last report. We expect Heineken's emphasis on top line growth and premium brands to enable it to outperform global beer market and peers in the long run, particularly post-pandemic, is part of the evergreen strategic journey. We've also done a seasonality test, as you will see in the graph below. We did this test to see how the demand differs from the first half of the year to the second half of the year. As you can see, the second half tends to have stronger sales on the back of English Premier League season, coupled with festive season demand. This year particularly, we're also expecting the on-trade to improve due to COVID vaccine rollout. So we should start seeing these recoveries then effectively on the second half of FY21. So for these reasons, we're maintaining a neutral recommendation on the stock. Should you wish to place a trade with us, please speak to your financial advisor or contact our trading desk. As we end off, I'd also like to draw your attention to the following disclaimer. Thank you for your time.